Hello everybody and welcome to the latest in our series of Dafferns webinars. This one today is with Dafferns Wealth, who are part of the Dafferns group and are independent financial advisors specialising in pensions, investments and protection. Dafferns Wealth is a relatively new business and it is an appointed representative of Insight Financial Associates, and Dafferns have been working with Insight for about 18 months now. The two speakers on today's webinar are Steve Wheatcroft and Rachel Legg. Now, Steve has been working with Dafferns for just about 10 years now, I think, Steve.
Yep.
And is well known to Dafferns staff and to lots of our clients. Rachel, we first met you 2 years ago as we started to work with Insight. You've also got a huge amount of experience as an independent financial advisor. And the presentation today is going to be split between the two of you. So if I now hand over to Steve.
Thank you, Martin, and good morning. Right, thank you. It's a sort of glum and grey Wednesday morning, so it's probably just the right atmosphere to start talking about inheritance tax and death and all this sort of morbid stuff. But let's try and be positive. Let's try and find answers. So we've got an agenda here. We're going to talk about what actually makes up an individual's estate, so what the tax man is going to go after. And then we're going to look at how we make sure that we do any sensible planning to reduce that taxable estate, and also just make sure that the estate ends up, excuse me, where you want it to be. So as part of that, we'll talk a little bit more about inheritance tax, and then I'm going to hand over to Rachel to talk about long-term care, the implications of remarriage, and the implications of dying without a will. And then we'll go on to look at some planning opportunities. We're very lucky, Dafferns Wealth. We work very closely with the Dafferns team, and that's a real positive. And particularly with the tax team, it means that we can offer a sort of very rounded service to Dafferns clients. When it comes to estate planning, ideally, we also want to bring in the legal advisors as well, because obviously if they're involved as well, then we know we're all moving in the right direction. So, what's the tax man going to come after? Well, the bad news is that for most of us, if we were born in the UK or have moved permanently to the UK, it's everything. Any asset you've got anywhere in the world is fair game for HMRC. It's as simple as that. You might have a bit more scope if you can prove that you're not domiciled in the UK. So, for example, you might have a nice little house in Spain. Well, just bear in mind that if your family want to keep that house, they may well have to pay a chunk of tax on your death in order to do so, because it's all part of that calculation. The tax man will take into account any asset, any chattel that you've got. So that might include cars, paintings, jewellery, and obviously any investments or cash that you've got, and of course your homes. Now then, I'm going to mention the 7-year rule, and this is going to be a recurring theme throughout the presentation. A lot of you will probably know if you decide to gift assets to anybody, your family, you have to survive 7 years after the date of the gift for them to fall out of your estate. And so obviously that means that when we're looking at the value of an estate on death, we've got to look back over 7 years and see whether that means that we need to include any gifts that were made. But there is good news. I mean, there are assets that actually the tax man can't touch. And we'll go over these in a bit more detail later, but basically any business asset. So if you own a business or if you own shares in a small trading company, usually that will be completely exempt under something called business property relief. So that's great news. Has a bit of a disadvantage in that if you ultimately retire and sell that business, then overnight you might be substantially adding to the problem of inheritance tax because you've converted it to cash. So we'll think about that as well. The other big asset that they can't touch is any pension that you've got. If you have a pension in just about any form, it will be written in trust. It is therefore not part of your estate. You may well pay other taxes on it, but you will not pay inheritance tax. And the same applies to any death in service life cover that you might have, typically your multiple of salary, 4 times salary, that will be paid around your estate and will not be subject to inheritance tax. So that's a bit of good news. And of course, there's also the possibility that you've got some life cover. So the important point here, and we'll probably emphasize this again, is that if you've got life cover, for heaven's sake, make sure it's covered by some sort of trust arrangement. You do not want that to fall into your estate and be potentially subject to 40% tax. So if you've got existing cover, we can look at that. And obviously, if you take out any new cover, it's just a question of making sure that you have that in place. Now, inheritance tax. Over the years, a number of people have said to me that they think it's an unfair tax. You go through life, you pay income tax, you pay national insurance, you might pay capital gains tax, corporation tax. You'll certainly pay VAT on most of the things that you buy. You'll pay petrol duty, tobacco duty, alcohol duty. So is it really fair that on death they're going to come back at you and try and get another 40%? Well, I'm afraid the answer is that fair or not, that's what they will try to do. But actually, is inheritance tax a very effective tax for the Exchequer? Now, there's a few stats here. Again, being a bit morbid again, usually over 500,000 people die each year. But at least only a relatively small proportion of those estates will suffer inheritance tax. So you'll see here in the tax year ended 5th of April 2017, only 4.6%, about 28,000 people, actually ended up having inheritance tax liabilities. So great, 95% of people actually don't pay inheritance tax, either because they've not got enough money or because they've benefited from some very good planning. Just to put it in perspective, it doesn't generate a huge amount for the Exchequer. £5.4 billion might sound like quite a lot of money, but in that tax year ended 5th of April 2019, the total tax and duty take was actually £628 billion. So inheritance tax actually accounts for less than 1%. So for comparison, corporation tax that year, 54 billion, income tax 191 billion, VAT 132 billion, even tobacco duties dwarfed it at 9.7 billion. So it's not a huge earner for the taxman in that sense. But if anybody's thinking maybe they'll abolish it, I don't think so, and particularly not now, because of course the government's going to need every penny it's got for the next couple of years. So you'll see that there was a significant reduction in the take back in 2007 when the nil rate bands were increased. But actually since 2009, we've seen a fairly steady increase in the amount of inheritance tax that's been paid. And that's partly because the nil rate band, which I'll talk about in a minute, hasn't changed since 2009. So obviously inflation itself will take people through. And of course, property prices have increased a lot over that period. So more and more people are getting caught in this net. You may know, husband and wife can happily transfer assets between themselves without any inheritance tax implications. So that gives us a bit of extra scope. But the bottom line is that each individual will only be taxed if their estate exceeds £325,000. So therefore, a married couple, that means that they can have up to £650,000 between them. And because the allowance is transferable between them, if they're first to die, and of course that's usually us chaps because of the stress and the pressure that we live with, if it's not all used on first death, any remaining nil rate band remains available to the second. So the first 650,000 is broadly going to be okay. But we've actually had, for the last couple of years, an additional potential benefit, residential nil rate band. So if you own your home and you intend that that's going to be left to your immediate descendants, children and grandchildren, you get an extra £175,000 that's not going to be taxed. It's gone up to £175,000 this April. So that makes it £500,000 each, £1 million for a married couple, which I think was one of the Conservative Party objectives. So it sounds pretty good, but just be a little bit careful, because if your estate exceeds 2 million, then they actually start to claw back that resident non-rate band. So it's of little or no benefit to larger estates. There are some other exemptions. So for example, you can give specific gifts when people marry. There's a small gift exemption. And one that people tend not to take advantage of is there's an exemption for gifts that are made out of income. So quite simply, if you don't spend all of your income, then what's left you can pass on with no inheritance tax implications. So if you've got 50,000 net income, but you only need 30, you can give away £20,000 a year out of the income, and that's absolutely fine. As I said, transfers between spouses are absolutely fine. And we come back to the 7-year rule. A lot of the planning, because the good news is we have got quite a few weapons in our armoury. So a lot of the planning that we do will take advantage of the 7-year rule in some way. It isn't always easy. Obviously, anybody is going to be thinking about their own future and whether they can afford to give away capital. But we can help you to think about whether you can, and there's a couple of little tools that we can use to make it just a little bit easier. But if you do make gifts, it has to be an absolute gift. You cannot retain any interest. So going back to that property, that nice little holiday property, yeah, you can put it in the kid's name, but you can't use it, because if you're using it, it's a gift with reservation unless you pay the full market rent to use it in future. So you've got to be careful. Bottom line is, we think most people will benefit from taking some independent financial advice, generally, but of course specifically on inheritance tax. And the first point here is we are very happy to have a chat with anybody to get a general overview, and that's a free consultation. No charge for an initial chat, and then obviously if we do any work beyond that, then we'll let you know if there's any cost involved.
Brilliant. So Steve's covered the inheritance tax issue, but one of the other concerns that we often find when we're chatting to clients is the fear that their estate is going to be lost or severely impacted by care costs. Looking at the stats here, we can see that a third of us ladies and a quarter of gentlemen actually end up going into care in some way, shape or form. And it's estimated that by 2034, some 88,000 of us will actually reach age 100. I don't know how that makes you feel. Certainly it makes me feel quite tired, just the thought of reaching that. But that's, you know, the older we get, the more of us are going to need care. In terms of the cost of that, again, you can see from the slide that it tends to be between £600 and £1,200 a week. And typically, I don't know what Steve finds, but I find that typical costs are around the £1,000 mark. So it's not cheap to go into residential care. Some
say, Rachel, yes,
us,
members of our family, my family, it's just over £1,100 a week. Yeah,
incredible, and actually finding that, and so that brings us then to the last point here, that actually around 40,000 of us a year are forced to sell homes actually just to fund that. Now there are things that you can do, and Steve's going to talk about some of the solutions, but I just want to sort of interject here with one that's specific to this. In the UK, if we get married or when we get married and we buy a property, we tend to buy it as joint tenants. And the definition of joint tenancy is essentially when, and this is fairly unique actually to the UK, everybody else tends to do it a slightly different way, but when you buy your property, you both own 100% of the property. The implication on first death of one of the partners is that then the surviving partner owns the whole property themselves. Okay. Now, of course, one of the implications of that is that if that surviving partner then goes into care, then the whole property is available for sale or to actually use to fund that care. So actually quite a straightforward solution to that is that, again, this only works for couples and if you own a property together. But if you own that property as tenants in common rather than joint tenants, this is where you own a specific portion of the house. So you might own 50-50, 70-30, 60-40, but you actually own individual bits of the house. What you can then do is in your will is specify, okay, on my death, on first death, I want to leave my portion of my property to the children or whoever that might be, and that's in trust. So then, on first death, that's there in the bag for the children. But on second, for the second person, if they end up going into care, then the local authority can't touch partner A's bit of the property. It is there for the children or whoever you're leaving it for. So it's just really to let you know that there are things that you can do that are fairly standard to actually start protecting some of your estate. Now, Steve's talked about sort of inheritance tax and the 7-year rule. And sometimes when people are thinking about care, this kind of gets swept up. So just for clarification, I just want to say that actually there's no 7-year rule in relation to money being used for care homes. And sometimes when we're talking to folks, they would rather give away their house or big chunks of their estate to actually avoid paying care costs. But you have to be very, very, very careful if you're considering doing this, because there is a rule called the deprivation of assets. Now, if you end up ultimately going to a home and you've given chunks of your estate away, you need to be very careful, because actually what could happen is the local authority could turn around and say, well, actually, we think you've done that to specifically avoid paying care fees. And what they will then do is they will deem that gift to still be part of your estate. And they could even go back to the person you've given it to reclaim that. So if you are thinking about giving money away, be very careful. If you think you might need care in the near future, so if you're not feeling well, if you've got underlying health issues and it's a possibility, be careful. Don't ever tell anybody that you're doing it to avoid paying care fees. I have seen this written down when I've looked at clients' paperwork that something's been recommended to them to avoid paying care fees. If you do that, straight away, the local authority will be aware. So just be very careful about how you do that. And really, if you're going to give gifts, make sure that there is as much time, at least sort of 6 months, between that gift that you've given and the possibility of going into care, or else it could all fall down around your ears. Okay. One thing I also want to comment on here is again, people will often say, can't I just give my property to the children? And Steve's already sort of talked about this idea of giving something with a gift of reservation, still wanting to use it. But even if you put something in the children's name and you give something directly to your children without use of a trust or anything, be very careful. Because if you want to stay living in that property, but you've put it in your son or daughter's name, for example, and they're married, if that marriage breaks down, you could suddenly find that actually you've got a daughter-in-law or a son-in-law wanting to sell your house so that they can get their share of the property. So just be very, very careful with that kind of decision. Again, some pitfalls to avoid. Please be aware that on marriage, any wills that you've written in the past will become null and void. Okay, so marriage, civil service, civil ceremony will mean that you have to write a new will, unless you stated in the will that it's been in contemplation of marriage. So if you've got that clause in, you would be all right. But otherwise, marriage means any previous will be null and void. Now, what is sideways disinheritance? I know, Martin, when we looked through these slides together, you sort of said, what is sideways disinheritance? I'm going to give you a personal family situation, actually, is a really good example. So my grandma and granddad, my mum's mum and dad, had done basic mirror wills. So the old, I leave everything to you, you leave everything to me, and then it goes on to the children. Thought they'd done everything necessary. Now, unfortunately, at the age of 67, grandma then died, leaving the entire estate, the bungalow, savings and everything, to granddad. A couple of years later, granddad then met a new lady and they got married. They did their basic mirror wills, as they thought they should do. And unfortunately, on granddad's death, which came next, everything was then left to his new wife. So this is sideways disinheritance because her will actually said, and I'm going to leave everything to my children. So actually mum was disinherited from the will. This doesn't happen to have to happen in just that way. It can be, you know, a second marriage bringing two families together. It can happen very easily if you're not aware and you're not sort of reviewing those wills. So really important to sort of give some consideration to that. The last point we've got here, the law does not recognise love or trust. And of course we mean in terms of the emotion and the action when I say trust, not the legal entity. So essentially what I want to say here is if you are not married and you're a couple and you've not got that legal sort of regime in place, then don't expect necessarily your partner to get everything. We really have to be very careful about the assumptions that we make in terms of how things will work. And the next slide, Martin, actually gives us a bit of a taste of how things might work if you don't make a will, or if, as the term says, if you die intestate, because there is a legal flow through which your estate will pass in terms of who gets what. There are very few people who can sort of get away without writing a will really and still have their wishes fulfilled. For most of us, there are things that we should absolutely have a will in place. And if you can, I don't know if you can see, you may have to get very close to your screens to see this, but you can see the flow of where your estate will go. So it means that not necessarily the right people will get what you want. And there have been occasions when I've gone through this process with clients, perhaps a couple who haven't got children generally, and you go through the flow and you actually realise that actually a wayward brother might end up getting the money, or a sister. This is where you become very aware of sibling rivalry and the thought of the horror of a sibling getting all of your estate may not be palatable. So it's about understanding what it is you want to achieve, and if you don't do a will, actually where will that estate go? We've also got this comment here about tax efficiency or tax inefficiency of letting the rule of law just sort of take its course. You could have a situation actually where your estate ends up perhaps being passed back up the generation to parents. And of course, then if you're adding your estate onto their estate, then we come right back to what Steve was talking about, potentially with inheritance tax problems. So you're actually sort of, by not making these plans and putting the flow in place that you require, you could be missing opportunities to save a bit of tax there. I'm going to hand back to Steve now, and he's going to look at some more of the solutions that you can actually consider to help address some of these issues that we've looked at so far.
Yep, so as that suggests, it's all very well recognising the problem, even quantifying the problem, but what can we do about it? Well, the good news is there's quite a lot we can do. If you've got scope, then you can consider making gifts so that you remove assets from the estate, reduce the size of the estate and reduce the problem. The problem obviously is a lot of people don't feel comfortable doing that. They need to be absolutely sure that they're protecting their own future first. As Rachel said, it's critical that you have an appropriate will in place so that you know that your estate won't be distributed in accordance with your wishes. And it's also important to review that. It's amazing how often you sit in front of somebody talking about wills and they say, yeah, I've got a current will, but actually it was written 30 years ago. So common. And in principle, if you can, you take advantage of the allowances that are available and are routine parts of the legislation. In particular, that one about making gifts out of surplus income can be really useful. As I said, we've got a few options. A lot of them involve some form of trust, but I'm just going to concentrate on the one for the moment, and this is something called a discounted gift trust. Now, as I said, the problem with giving money away is that you've got to be very comfortable that you can afford to do that you might not need the capital, or that you can live without any income from that capital. And that often means that people simply don't make the gifts that they could. And this gives us a sort of way out. Now, a discounted gift trust is a mechanism where you can take a sum of money, I'll say £100,000 to keep the math simple, gift it into a trust so that you've lost the capital, you've given away the capital, it's now in the trust. But you can be a trustee in your lifetime, so you can retain some control over what happens to the money in the trust. And importantly, with this particular type of trust, whilst you've given away the capital, you retain the right to income that's generated in the trust. So it gets over that potential problem of, can I afford to do this? Because if we use an underlying investment, which is a capital investment bond, it enables the trustees to generate an income of 5%, up to 5% per annum, without any tax implications for the trust, that can be passed to you, so you can enjoy a 5% income. As far as you're concerned, that is tax-free. You don't pay tax on it. You don't even have to declare it on your tax return. So it just might make it that little bit easier to consider giving that money away. Importantly, in doing that, you've started the 7-year clock. So that £100,000 will fall completely outside the calculation of inheritance tax after 7 years. But also you'll notice it's called a discounted gift trust. And that's because HMRC recognised that although you've given the £100,000 into the trust, you've retained the right to the income. So the value of the gift isn't actually 100,000, it's significantly less. So even if you don't survive the 7 years, the probable discount is usually at least 50%. So yes, you save the full inheritance tax on that 100,000 after 7 years. You don't survive 7 years, you normally save at least 50%, often quite a lot more. So works as a gift without quite so much worry about giving it away, gives you a very tax efficient and quite high level of income. And even if you don't survive 7 years, it can still significantly reduce the inheritance tax bill. That's a really good tool. We use it a lot. And it gives a lot of people comfort that they can perhaps afford to give money away when they were reluctant to do so. Second option there, I mentioned earlier, business property relief. If you have a business asset, then in most circumstances, that's actually exempt from inheritance tax. Well, actually, you can invest in assets that themselves qualify for business property relief. A lot of very good fund managers have specialised in this and set up funds which are very well diversified, very well spread funds that only invest in companies that are quoted on the alternative investment market. And the beauty of that is that if you invest in that fund, after 2 years, that investment becomes completely free of inheritance tax because of the business property relief. The money's still there. If you do need to pull it out again, it's still accessible. But it's obviously a useful way of sheltering some of your estate if you're comfortable with that type of investment. I'll talk about it a bit more on the next slide as well. A simple option, obviously, is just to take out life insurance. Create a fund that your dependents can use to pay the tax if you have some idea of what that tax liability might be. Again, absolutely crucial. Please make sure that if you do that, it's written in trust. The last thing you want is for that money to fall back into the estate and suffer tax at 40%. Gift into vivos, this is a simple thing. It's if you do decide to make a gift and you're worried that there is this potential tax liability for the next 7 years, this is life cover specifically designed to cover that 7-year period and the amount of that tax that might be payable on a reducing basis over the 7 years. And the final point there comes back to pensions. If you've got a significant pension fund, it's got to be worth considering leaving that intact. I've got a lot of clients who have got big pension funds, but they're lucky enough to also have plenty of other assets. So actually, they can afford to take their income from the other assets which would otherwise suffer inheritance tax and leave the pension fund intact and available to their families. Won't work for everybody, and it may be that after a while you've got to tap into the pension fund anyway. but it's got to be worth considering. It can save quite a lot of tax. So yes, just coming back to this business property relief, these funds that are available have worked pretty well. Yes, by definition, the sort of companies that they're investing in do involve some risk. So you've got to bear that in mind. If they're a low-risk client, it's not appropriate. But if you're prepared to accept a bit of risk, you can get a decent return with this additional benefit that after 2 years, it's going to be free from inheritance tax. And it's even available as an ISA. So even if you just use it to take advantage of your ISA allowance each year, over a period of time, you can build up quite a large fund, which is literally just outside the net for inheritance tax.
Thanks, Steve. So as advisors, one of the most important things we can do for clients is actually to look at their cash flow planning. So this is where we gather a whole host of information from clients and kind of try and pull it all together. So you can see here from the screen, we've got an example. And we've collected information of bank accounts, investments that they hold. We've got the family house in there, the home, investment bonds, pensions, everything that they own. And it's important to capture everything. So we're pulling all of that together, making assumptions about what sort of growth might happen over time given those. We'd also ask for information about what sort of income will be coming in at various stages of life. You know, when might state pension kick in, what are current incomes, all of those sorts of things. And then, what are your outgoings? And the more accurate you can be with this, the more effective this kind of planning can be. And thinking about the future, you know, if you've got children going to university, does that change? What are your plans at retirement? How will your outgoings change at retirement? What do you need to come in? And also, importantly, when you're looking at your outgoings, we're making assumptions about what inflation might do over the period as well, so you can get the full impact of everything coming together. And then you can see here that we've got sort of the red and green chart and the blue column chart. We can assess what the outcomes might be as time goes by. And it might be that you're looking at, can a client afford to retire at a given point? And you can see on the example here, green is good, red is bad. But for this client here, given their circumstances, they may not get to retirement just based on their incoming and outgoings as they are currently. So you might have to tweak things. It's not just about assessing your ability to get retirement as you want to, but it could be actually what happens if you're a couple, what happens if one of you passes away? Can the surviving partner continue to survive in the way that they have been doing? But actually, cash flow planning in the scenario that we've been looking at today is really helpful in us sort of determining whether an individual is going to have an inheritance tax issue in the future. But what you can see is you can see the flow of how your estate might end up being at a certain point in the future. It also then helps us understand all of the issues that Steve was talking about in terms of what are the options. Can you afford to give away chunks of money? Can you afford to put money into trusts that you're no longer going to have access to? If you can't, then it might be looking at things like the inheritance tax plans or the inheritance tax ISA, where you still retain access to those chunks of money. So doing the cash flow planning is actually crucial and is central. So a lot of the planning that myself and Steve do with clients for all aspects of life plans and financial plans going forward. So really, just to sort of summarise some of the issues that we've looked at today, what is your priority? I think for Steve, when we're talking about people and we're asking them to talk to us about their objectives, what is it they're trying to achieve? Quite often when we get to the idea of legacy planning, it is about, I want to pass as much of my estate onto my loved ones as possible. That's kind of the bottom line. And then it's down to me and Steve to actually sort of say, well, actually, what are the biggest threats for you? Is it inheritance tax? Because actually for many folks, that isn't an issue. You've got to have a certain level of overall estate for it to be an issue. But it might be care fees that is your concern. But it's all these sort of leakages from your estate that really we want to look at to try and make sure as much of your estate can be passed on to the right people at the right stage. So what's your objective? That really is the point there. And then if you've started to make plans, if you've got a will in place, have you reviewed it? Is it still up to the job? Does it actually do what you think it's going to do? If you've got trust in place, anything like that, is it still relevant? Steve's mentioned the BPR qualifying investments, the inheritance tax plans, the BPR, the ISAs, the inheritance tax ISAs. These are newer things. These may be things that perhaps you weren't aware of and perhaps weren't available to us a couple of years ago. So it's really worth reviewing what are the options now as things stand. Myself and Steve have been quite morbid. We've been talking about people dying. But actually things can come along during our lifetimes that can really cause us problems. And one of those, of course, is what happens if you lose mental capacity. And this isn't an age-related thing. It doesn't have to be Alzheimer's, dementia. It could be a stroke. It could be an illness. It could be being hit by a bus. I've got a client who I went to see, and actually it was a skiing accident. So it's not an age-related thing. But if you lose mental capacity, how do you keep your estate running? What have you got in place? Now, actually, lasting powers of attorney are a main solution. Many of you will have heard of these and be aware of them, and may even have set these up for family members. But there are two types of lasting power of attorney. You've got your finance and property, which does all of the obvious things. It enables somebody else that you appoint to run your financial affairs. The other type of lasting power of attorney is the health and welfare. Some people perhaps view this as being less important, but actually I think it is incredibly important actually to be able to nominate a person that you trust to look after your health and welfare issues and concerns. So if you've not thought about that and you're in the process of reviewing wills and stuff like that, then it is a very good time also to give consideration to should you be doing a lasting power of attorney, and probably in most cases that is an absolutely a yes. But I think the essence of all of this is that between myself and Steve and all of the tools that we've got available to us, we are in a position to actually help people plan for their future by using the right products and working with the team at Dafferns in terms of getting the best tax efficient routes. What is your actual situation now? Where are we headed? And what are the most important issues to you? So it really is a case of, and Steve has mentioned this, if you would like to spend some time with either myself or Steve, we do run an initial consultation at no cost to you, and we'd be delighted to have that chat. I'm going to hand back to Martin because I think there have been some questions coming in.
There are. Thank you very much. Yeah, the timing is going really well at the moment. And got a question from Brian King, one of the Dafferns partners. So I will turn Brian's microphone on.
Yeah,
carry on, Brian.
A comment rather than a sort of question. At Dafferns, I'm one of the tax team, and so I do work closely with sort of Steve and Rachel. I'm sitting with them when we meet sort of clients, and trusts were mentioned quite a few times in the sort of presentation by Steve and sort of Rachel. And it's quite common that when we're in the meeting, when trusts is brought up, there is a little bit of a sort of reluctance from sort of the person. They think that trusts can be expensive and too complicated and not necessary for their affairs. But really, from a tax point of view, trusts can be sort of really, really good in terms of sort of like planning. It can save a lot of tax. And in our experience, it can be set up without it being too costly. So it's the tax people at Dafferns working with Steve and Rachel and their solicitors. Instructions can be given to the solicitor to create a trust, and it's effective and not too costly. So my view is that people should not dismiss trusts, but embrace them because they are a fantastic planning tool.
Couldn't agree more, Brian. That's absolutely right. And the good news is that sometimes the trust document is actually an off-the-shelf option as part of the product that we're recommending. So there might not be any cost at all. And you still get all the advantages of the trust.
Putting a trust in place actually isn't always just about tax either. One of the huge benefits I find is for what I call bloodline planning. So it may not actually have anything to do with the tax saving or anything like that, but actually is determining where you want money to go. So you're putting in a protected bubble, if you like, and you might use that to make sure that money does go down in the right order. So it doesn't leak off to ex-wives, ex-husbands, all that sort of stuff as you go down the line. It gives you more control. So if you've got a situation where you've got family, and this happens in every family, but you've got, for example, a child who may have some issues, perhaps it's gambling or they're in debt or have addictions or something like that, and you would be reluctant for them suddenly to inherit a whole wad of money. By putting money into a trust, you can protect how this is distributed and where the money goes. So it's putting money into a trust is not just about potential tax savings, but is about control and protection for that estate and making sure as much of it goes in the right direction.
Just to enhance what Rachel was saying, is that people do warm to the idea that they don't necessarily have to give away their assets, and that's the end of it. They really do like the idea of trusts when we explain to them that they giving the asset away, but they are still retaining the control of the asset.
Absolutely.
And depending on the type of the trust, they can direct some income or capital to specific people. So they really do like that flexibility.
Brian, while you're on, another question that's come up that might be for you. Would a tax return need to be prepared for a discounted gift trust?
I think what you may have to do is register that type of trust with the Inland Revenue, because there is an obligation to register trusts. But typically, the asset of a discounted gift trust, it will be an investment bond.
Yeah.
So an investment bond only triggers something that needs to be reported for tax only in some circumstances, and that is typically when the bond is surrendered. So with the investment bond, that's part of the discounted gift trust that Steve mentioned. It is possible for the person making the gift I think they can take out 5% of the value of the initial investment without triggering any income tax liability or any reporting requirements. So a discounted gift trust can continue for many, many years without having to report any event on a tax return.
Exactly right, Brian. Yes, the underlying investment does not generate taxable income, and therefore there's no need to report anything unless or until there's a full or partial withdrawal of capital.
Okay. There's another question this time for Rachel, which is probably one which is going to be a very common question. So Rachel, if a couple own a property as tenants in common, does this give a problem with the surviving partners selling the house?
So there's several different points to this. So if you've got the will in place, the trust only springs to life on first death. So that's the first thing just to sort of make aware. So when you're writing the will and you're both around, both healthy and all of that sort of stuff, there is no implication at all. Okay, it is just something that's in your will saying this is what I would like to happen. So that's the first thing. It is on first death that actually that trust springs to life, if you like. So the money that is held in trust will have trustees. So typically, for example, and I'll give you a family example again here. My parents-in-law, this was arranged for them, father-in-law passed away. So actually, mum-in-law, my husband and his sister are trustees of his bit of the house. So actually, she did move out of the family house, purchase a new place, and it was just that the trustees had to sign for that purchase to take place. So it's just, you've got different people dealing with it. So it would be the trustees of that portion of the house that would need to be involved as well.
Yeah, there's a follow-up question from the same attendee. How do I check if the ownership of our house is in the position of being tenants in common? And also, in moving to that, does it change what actually has to be registered with the land registry, and how does it impact mortgage?
Right, so you check with land registry. That's actually where you check how it's held. When you check deeds, it is so difficult for the layperson to actually suss whether you're tenants in common or joint tenants. I would say, generally, if you're unsure and you've never had that conversation with a solicitor, the default is to go down the joint tenancy route.
Yeah.
So that's kind of where most of us end up being sat automatically. It's if you've had a conversation with the solicitor that you tend to be as tenants in common.
Okay.
The only safe answer, if there's any doubt, really, is to check with the solicitor who dealt with the conveyancing.
Yeah, absolutely. And sorry, in terms of the mortgage as well was the secondary part, wasn't it? Yeah, there's no real issue with changing any of that. One issue that is worth raising, if you have a situation where you've had the first death has happened and you've got the property now held in the name of the surviving partner and the other chunk being in the name of the trustees, if you decide at that point that you do need to, partner B decides they want to go off and move and they're looking for a grand house and they now need a mortgage, then you would need to be very careful, because if you've got a chunk of the property being owned by a trust, you're going to find it incredibly difficult to get that sorted. So that would be the one proviso that I would say sort of with regard to mortgages there. But tenancy common, joint tenancy, the mortgage provider, generally it's not an issue.
Okay. The next question is for Steve, asking the question about the current COVID crisis. What sort of impact that has had on investments that you've been advising clients on?
I've been pleasantly surprised. The average impact has not been that severe. We're seeing typical falls in valuations around about the 10% mark, and I don't quite know why, but we're also seeing a fairly consistent recovery. So the market was up again this morning at sort of 6.2. So generally speaking, not too bad, but there's a long way to go and a lot of potential holes to fall down on the way. The good news is that the fund managers that we use put a hell of a lot of resource into this. They've done all their modelling, their worst case scenarios, they've taken defensive moves where they think it's appropriate. So that for most people, we're not expecting any dramatic falls in the short term.
And it is a long-term game.
Yes.
As well, that you're playing rather than a short-term game.
Yeah,
absolutely
and
right.
of course, when myself and Steve are chatting with folks, we take one of the primary objectives is what level of risk are you prepared to take, and what can you afford to lose? That's a big part of the conversation. So we would always be endeavouring to make sure that any kind of investment decision is appropriate for that individual.
Okay, and maybe just as a way of wrapping up, one final question that's come up on the chat is, what would be the one recommendation that you would make to somebody considering estate planning? So if we start with Rachel, what would your number one recommendation be?
Get an up-to-date will, review your will.
Yeah,
definitely.
I agree entirely. The starting point has to be the will, but I think the second issue is just understanding the extent of the issue. Is there a liability?
Cash flow planning.
But just to say thank you very much, Rachel and Steve. That's been really interesting. As Steve said, first meetings are always free. Please feel free to get in touch, either through the website, daffernswealth.com. So if you found this video useful, please give us a like or subscribe. Watch out for more Dafferns webinars to come over the next few weeks and months. So with that, thank you, Steve. Thank you, Rachel, and see you again on another webinar.
Thanks, Martin.
Thank you.